going to cover now is our borrowing basics presentation. You will know the value of credit and the different types of loans that are available to you. The importance of credit. Credit can be useful in times of emergencies. It is sometimes more convenient than cash. Like when you're buying a car, credit's going to be optimal. It allows you to make large purchases that you wouldn't have the money on hand for otherwise, such as a home. The first type of loan we're going to cover is a consumer installment loan. This is a loan where you receive a lump sum of money and you pay that money off in a given term. For instance, with an auto loan, you receive a lump sum of money for the car and then you pay that off in a predetermined period, such as over 60 months. At the end of this period, you will have paid off not just the cost of the car, but also the interest associated with the loan. Many loans require collateral, the most common being automobiles and homes. In the case of an auto loan, your car is used as collateral. In the case of a home loan, your home is used as collateral. This is so that if the loan is not paid, that the bank can at least get something out of it, such as taking your car back or your home back. The next type of loan available to you is a line of credit. A line of credit is where a credit limit is established. Say you have $500. You can spend up to that $500, pay that money off, and then spend that $500 again. Credit card gives you the ability to borrow money in an ongoing fashion for anything from household items, family expenses, personal expenses, or even medical expenses. There are fees associated with several loans. These are most common to credit cards. There are annual maintenance fees. In the case of a credit card, this is a fee you will pay every year just to have the card, even if you don't use it. There are service charges. This includes interest on your loans or credit cards. And then, of course, there are late fees if your loan or credit card is not paid on time. 3 C's of credit. These are very important because this is how your credit eligibility will be determined. The first C is capacity. This is basically your ability to repay the loan. So they will be looking at things like your income. Next is capital. This is what you're worth. So a common term that you hear nowadays is net worth. So they're going to be looking at the total of what you have in all of your accounts, your yearly income, what you own, car, home, or anything like that. Next will be your character, which is your likelihood or willingness to repay the loan. For this, they're going to look at your credit history, loans you've had in the past, and look at your pattern of repayment on those.